You've been trading for a while and you've learned so many different trading strategies, but yet you are still unprofitable. Hi guys, I've been trading for 4 years and just like you, I've also learned so many trading strategies and I've wasted so much time going around and around in circle until I realized I was actually missing one last piece of the puzzle, and that last piece was a trading edge. It is impossible to be profitable without a trading edge. So in this video, I will talk about what it means to have a trading edge in your strategy, and most importantly, how can we test your trading strategy to see if there's an edge over the market? Hey guys, how's it going? You really have to stop approaching trading the wrong way. Otherwise, you'll be simply gambling. Now, what do I mean by this? I want you to answer these questions honestly. Ask yourself these questions. Before you enter into a trade, do you have a logical analysis? And before you press that buy and sell button, is it because of something that you've seen in the past which led you to believe that this will bring you profit? Have you tested this strategy before? Do you have a criteria before entering into a trade? Does your strategy have a positive expectancy value, EV, or statistical edge? Now, if the answer to some of these questions are no, most probably you are just gambling. However, if all of these questions you answered yes, that means you make your decision based on statistical analysis. So you're not gambling. The difference between gambling and trading is gambling relies a lot on luck and is fueled by hope. So you hope for the best. You hope that your luck is better than yesterday, or you hope that your luck is as good as yesterday's. It's based on nothing. Whereas with trading, it relies on statistical edge and sound risk management. Now, as you know, people always say, because with the casino, the house always wins. Why do you think that is? In my humble opinion, there are two reasons why the house always wins. The first reason is the games were designed to provide dealers with better odds over the players. And the second reason is the rules were designed to provide dealers an advantage over the players. Now, the casino also has its own limitation. The best case risk to reward ratio is always 1-to-1. Meaning that if they lose, they could lose a lot more than just one. Now, what do I mean by this? Now, I want you to visualize a roulette table. You know, on certain bets, as a player, you get to win much bigger than your bet. Right? There are multiplication on certain bets, which means that if the casino lose that bet, the casino could lose more than just one. That is the casino's limitation. The second limitation is the maximum upside is only a player's chips on the table. So if you as a player, you bring $100 worth of chip on the table, the maximum upside is only that $100 worth of chip, unless the player or yourself or any other player decide to put more chips on the table. But they can't win more than what the players are willing to risk on the table. So the point that I want to get across is this. Even though they can't win more than 1-to-1, and even though the maximum upside is limited, the house still wins. Why? The reason is because they have an edge over the players. So what is an edge? An edge is knowing that one thing is occurring more often than another. And this is why the casino, it doesn't hope. It knew that the odds are stacked to their favor, and the casino isn't phased when losing. And I put a disclaimer mark over here. Only if you clearly have a proven edge, like the casino. Now, let me explain to you about casino's edge in the roulette table. So this is the player's probability. If you as a player bet on black, or you bet on red, at a glance you think that it is a 50-50% chance. But no, you are wrong. It is actually 48.6% chance of that being black or that being red. Why? Because of this little simple zero on that table. This is the casino's edge over the players. That one simple, subtle little thing makes a difference. That means if you bet on black, the casino has a 51.4% chance to win. Why? Because if you bet on black and it falls on the green, the zero, the casino wins. If you bet on black and the ball falls on red, the casino still wins. So this little zero adds 2.4% edge over you as a player. So if, say for example, a sample of 10 spins, and you have a probability of less than 50%, okay, and you need to have a runout number, it is very possible that you as a player, out of 10 spins, you will win 4 and you will lose 6, which means that 4 minus 6 is minus 2. That means you have a negative EV of 2. And as for the casino, out of the 10 spins, they will lose 4 and they will win 6, which means that they have a positive EV over a sample of spins. Now, as a contrast, let's imagine that this is either by design or by accident. This roulette wheel has an extra black on it. Now that extra black will become your edge if you bet on the black, because it has one extra black over the reds. That one extra black adds 2.7% probability to your favor, which means that for every 10 spins, it is very likely that you win 6 and you will lose 4. 6 minus 4 is plus 2. That means you have a positive EV of 2. That is your edge. Now that we have understood that trading is a game of probability, we now realize how important an edge is into your trading strategy. And we have also covered that even though everything has its own probability, the distribution itself will always be random. So how do we use this new understanding into refining our trading strategy? So this is what we'll do. I've picked 3 simple basic trading strategies, nothing too fancy, with very basic, easy to follow rules as well. And what we'll do, we will test these strategies onto the chart, and I will use the replay mode on TradingView. We'll tally the results onto the spreadsheet, so at the end of this exercise, we know which strategies will give us the best edge. Now, strategy number 1, it's called moving average or MA crossovers. Strategy number 2 is the consolidation breakouts. Strategy number 3 is the trendline breaks. Now, before we go to the chart, I will briefly explain how this strategy works. Right, for strategy number 1, the moving average or MA crossovers, it is to enter into a trade whenever the 50 MA cross the 200 MA or the 50 moving average cross the 200 moving average. The rules are simple. If the 50 MA crossed above 200 MA, then we look to buy. If 50 MA cross below 200 MA, then we look to sell. The stop loss or SL is below previous bar low or high if buying or selling respectively. You open, take profit, so you leave the take profit open. You don't set the take profit. You trail your stop loss until the 9 MA cross over the 50 MA. And everything will make a bit more sense when we're on the chart. So this strategy is relying that price will continue into our favor until it says otherwise. So this is why we keep the take profit or the TP open. We don't actually set a defined price level when we actually exit the trade. Okay. This is an illustration of the moving average crossover strategy. So the green one is 9 MA, the blue one is 50 MA, the red one is 200 MA. So if you visualize that price is making bearish structure, making lower highs and lower lows, and as price moving up, making higher high and higher low, you wait until the 50 MA crossed above the 200 MA, whereas in this case will be right here. Right? So this is when the point where the blue line, 50 MA, crossed above the red line, the 200 MA. Yeah. And that's when you look to buy and you hold that position, keep on holding, doesn't matter what price do, until the 9 MA cross below the 50 MA. This is when you take profit or you close your position. Don't worry, I will show this to you on the chart as well. Everything will make much more sense there. Right, this is strategy number 2, the consolidation breakouts. So basically, it is price consolidating for a period of time and then look to get into a trade upon the breakout of that consolidation range. So the rules: price consolidates for a period of time, minimum 1 hour. If price breaks out above consolidation range, then you buy. If price breaks below the consolidation range, then you sell. SL, stop loss, is the support or resistance of the range when buying or selling respectively. So if you have a range and price breakout above the range, which breaks the resistance, your stop loss will be on the support. Vice versa, if price making a range and price broke the support, and then you look for sell, the stop loss will be at support. And then you TP, take profit 1-to-1. So if you're risking, for example, 20 pips, then what you do is you take profit at 20 pips in profit. Okay, so this is an illustration of consolidation breakout strategy. So you have a clear defined range between resistance and support, price kind of making a range there. And upon the breakout of that range, you look for buy, and vice versa. If price actually breaks this support, you look for sell. Okay, so this is strategy number 3, the trend line breaks. Price starts a trend, and we look to enter into a trade upon the break of that trend line. And the rules are: price creates a trend line with minimum of 2 touches. Price then breaks and close outside of the broken trend line, which means that the candle has to close outside of the trend line. If price breaks below trend line, then you sell. And if price breaks above the trend line, then you buy. Stop loss is inside the trend line, and you take profit 1-to-1. So again, if you're risking 20 pips as your stop loss, then you take profit at 20 pips in profit. Okay, so this is an illustration of the trend line break strategy. So price creating a higher high, higher low, and respecting this trend line, and you have more than 2 touches. So first touch, the second touch, third touch, the fourth touch, and then upon the break of that trend line, we look to sell, and then we cover ourselves stop loss above that trend line, and then we look to 1-to-1 risk to reward ratio. Okay, so let's go to the chart and test this strategy. So let's start testing strategy number 1, which is the MA crossover, moving average crossover. So what you have here on the top left is the 3 indicators. Well, 1 indicator, but using the 3 different settings: the 50 MA, the 200 MA, and the non-MA. The 50 MA is the blue line, the 200 MA is the red line, and the non-MA is the green line. Now, if you can't remember the rules, you can go back to the slide, but basically we look to buy when the 50 MA cross above the 200 MA, the blue line cross above the 200 MA, or we look to sell when the 50 MA cross below the 200 MA, which is the blue line crossing below the red line, then we look to sell. Once we're in a trade, we pay attention to the non-MA, which is the green line. So if you are in a buy position, you are in a trade already, we wait until the non-MA cross below the 50 MA. Once the green line cross below the blue line, then that's when we look to take profit or we get out from the trade. Vice versa, if you are in a sell position, you wait until the non-MA cross above the 50 MA or the green line cross above the blue line, then we look to close our sell position. Okay, so this is a replay mode. I've picked Monday 17th of June, which is not too far long ago. Okay, so let's start with this. Let me just hide that. Okay. All right, so far the blue line still below the red line. All right, okay, let me just pause it there. So it's almost okay. Right, so that's when the 50 MA is about to cross above the 200 MA. Okay, so if this is the crossover and this is the candle, so let's enter on the close of that candle, and the stop loss is the low of the previous candle, which is this one, and then we look to close our position by position until the green line, the non-MA, cross below the blue line. Okay, so let's just see what happens. Okay, we are still in the trade because the green line is still way above the blue line. Okay, we are technically still in a trade. Okay, there you go. All right, so that is when the non-MA crossed below the 50 MA. So the green line has now crossed below the blue line. Okay, so non-MA has crossed below the 50 MA, or the green line has crossed below the blue line. All right, so we will actually close right here. Yeah. Okay. All right. So if you see here, we were risking 3.1 pips, and then we close at 15.5 pips in profit. So that is a risk to reward ratio of 5. Okay, so let me just write that on. Okay, so strategy number 1 is 5R. Okay, all right, so let's continue again. And we will do a sample of 10 trades just to make it nice and easy. Okay, right, so that is, I think I overdid it. So that was when the price, so that was when the 50 MA crossed below the 200 MA, right, upon the close of that candle. Because it's below, so we would actually sell on the close of that candle. All right, and then we are in a position. Okay, sorry, we are in a position until the non-MA cross above the 50 MA, right? Which in this case, we have already been stopped out of position, out of the trade, even before the green line crossed with the blue line. Okay, so in this case, trade number 2, we have -1. Okay, all right, that's fine. Okay, let's look for, all right. Okay, right, so sorry, I think right, so right over here, the blue line actually crossed above the 200 MA. Right, the 50 MA cross above the 200 MA. So in this case, that means we should be buying on the close of, so this candle over here, I guess that's when, and then the stop is below the previous candle, and we look to buy until the green line cross below the blue line, the 9 MA cross below the 50 MA. Okay, so in this case, we get stopped out again. All right, so that's a trade number 3. So that's -1. Okay, now price is about to, the 50 MA is about to cross the 200 MA again. Okay, in this case, so that means in this candle here, on the close of the candle, we look to sell, and the stop loss is the high of the previous candle because it's actually in the sales position. Okay, and we continue to sell until the non-MA cross above the 50 MA. Okay, so we continue to sell. Okay, right. Okay, so we are actually technically, so there, right there. All right. Okay, let me just make this bigger for you. So this is when price actually, this is when the non-MA crossed above the 50 MA, the green line cross above the blue line. So we will close our position right there on the close of that candle over here. Okay, so this is when it's actually crossing, and that's actually the next candle, so we close it over here. Okay, so this gives us a ratio of 0.82 RR. So we were risking 7.6 pip for our stop loss, and our take profit was 6.2 pips, so 0.82. Okay, in profit. All right, so that's trade number 4. Okay, let's continue on. Okay, so that's when price actually, I think I overdid it again. Okay, so price, again, I keep on saying price, but anyway, when 50 MA cross above the 200 MA, the blue line cross above the red line, we look for the price, the candle when that happens. Okay, so the close of that candle. All right. Okay, and then we use the previous low. Okay, so in this case, because the low of that confirmation candle is lower than the previous one, we're just going to use the one before that, right? Probably makes, yeah, that's the most logical thing to do in this situation. So we will be in this buy position until the non-MA cross below the 50 MA, the green line cross below the blue line. Okay, so in this case, we're taking out straight away. So trade number 5 is -1. Okay. Can 50 MA still continue to sustain itself above the 50 MA for quite some time now? Okay, nothing to do. Continue higher. Okay, it looks the gap is narrowing, potentially having crossover soon. Okay, all right, so let's see. All right, okay, so it's not yet, it's about to. All right, so okay, so it's crossed over now. So because the 50 MA is about to cross the 200 MA, so I will look to sell on the close of that candle, and I will use the previous. Okay, so in this case, because the closing candle, when that's confirmed, is a bullish candle, and then you don't have anything higher looking for a sell position, you just look for the previous candle, keep on going further and further behind until you actually find the next high for your stop loss. Okay, and we will be in the selling, we'll be in the sell position until the 9 MA cross above the 50 MA, or the green line cross above the blue line. Okay, so in this case we get taken out straight away, so that's -1. So that's trade number 6. Okay, we're looking for the 7th trade. It's about to Okay, it's crossed. Okay, now the 50 MA has crossed the 200 MA. The blue line has crossed the red line. So I will look to buy and then use this as a stop loss, the previous bar low. And we will continue in this buy position until the non-MA cross below the 50 MA or the green line cross below the blue line. Okay, so in this case, we have been taken out before that crossover, right? So that's -1. Okay, right, but on the same token, the 50 MA has crossed below the 200 MA again in this case, so that is actually the confirmation candle when that happens. Okay, so I will use this, the previous candle high, as the stop loss. Okay, and I will continue to be in the sell position until the non-MA cross above the 50 MA. The green line has crossed the blue line. Okay, I'll continue selling. Right, continue still in the same in the position. Okay, still in the trade. Still in the trade. Okay, so this is when we get out. Okay, so this is when we get out. All right, so in this case, upon this candle, all right, so if that's 4.8 pip as a stop loss, if we move it from here, so that's about half. All right, so instead of actually, so we still it still hit our stop loss, so we're still in the loss, but instead of hitting our full risk, it will be 50% of our risk, so that's actually -0.5. Okay, so we're on the trade 1 2 3 4 5 6 7 8. Okay, so 2 more trades for this strategy. Okay, okay, the 50 MA is still below the 200 MA. Okay, nothing to do, but the gap is narrowing here. There's a potential crossover soon. No. Okay, still maintaining the gap and the bearish flow. Okay, might be okay. Let me just pause it here. Okay, so it might have a crossover soon. Okay, just pause it here. Okay, so that's the crossover. That's how the 50 MA has crossed above the 200 MA. The blue line has crossed the red line. Stop. Okay, so enter position here, and then stop loss below, and then continue into this buy position until the 9 MA and the green line cross below the 50 MA, which is the blue line. Okay, so in this case, we get stop out straight away. So that's -1. Okay, one last trade, and we should get our sample finish. Okay. And the 50 MA is still maintaining above that 200 MA. Okay, let me just pause it here. Looks like it's about to cross below. Okay, so price has crossed below. 50 MA has crossed below the 200 MA. Okay, so in this case, it's here. So the close of that candle, and I'll continue in the sell position until the green line cross above the blue line, which is the non-MA cross above the 50 MA. Okay, so in this case, we get stop out straight away. Now already, okay, so that's -1. So that's 10 trades. Okay, so let's start telling the results onto this spreadsheet. Okay, so the first trade was 5 risk to reward, 5R, and the second one was a loss, -1. The third one also a -1. The fourth trade was a profit of 0.82, was -1, -1, -1, and then it was 0.1, and then -1. Okay, now just in case you don't understand, so 5 means it was 5 times our risk. That was our winning for the first trade, whereas the rest, the second, third, fifth, sixth, ninth, and the 10th trade, we got taken out, so our stop loss was hit. So -1 means we were risking 1, whatever the value of 1 is. We can simulate that later in dollar value, but basically, for example, if you want to risk $10 for every trade, so for trade number 1, you would have profited $50, whereas in trade number 2, on the second trade, you would have lost $10. Basically, what it means, that's what it means. And in trade number 4, that means you would get about $8 if you're risking $10 per trade. Okay, and then for trade number 8, that means you actually lost $5 instead of the full risk of $10, because it's -0.5 of your risk. Okay, so as we stand now, without changing or improving or tweaking the rules, the win rate is 20%, which is not great at all. And then the expected value, the EV, is -1.68. Okay, so let's go into the next strategy, the consolidation breakout strategy. Let's go into the chart again. Okay, so now let's start strategy number 2, which is the consolidation breakout. If you can't remember the rules, you can simply go back to the slide before, but it is very simple. Basically, price is creating a clear defined range, a clear support, clear resistance. Price is just moving sideways, consolidating, and upon the breakout of the resistance above that range, you look to buy, or when price breaks that support below that range, and then you look for sell. Okay, so let's let me just hide this, right, because we are not going to need the MAs in this strategy. Okay, all right. Okay, all right, I can see that price is creating this range over here. I'll just put consolidation. Okay. Okay. So I see that wick here, price I did not close below that range. Okay, price did not close beyond that support. So this is support and this is the resistance. So as long as price is that candle is not closing below or above, I would consider it still trading within that range. Okay, so now price has closed below that support, so I will look to sell, and then stop loss just on that resistance. That was the rule, and then I will target 1 to 1. Okay, so that's the first trade. In the trade, okay, right, so first trade we took a 1. Okay, price is making another range here, it seems. Okay. Oh, sorry, I think I overdid it. Okay, so price has closed below that support, so I will look for sell here and then turn on that support. Oh, the resistance, sorry, that was, sorry, I did the other way around. I want to sell. Okay, and then I'll look for 1-to-1 again. Oops. Okay. Okay, so we got taken out, so that's -1. Right, so this is still in a consolidation stage. So even though there was what we thought was a breakout, there's a thing called the false breakout. So if we took that as a false breakout, that's why we got stopped out, and we see this one as the real breakout. The rule still applies that if this is still if this is actually a consolidation, and if that was the breakout, price would have actually gone further lower, but it didn't. It actually went back to the range, which tells us that price is still creating this consolidation phase. Okay, so we will buy when price close above that range, and we will use the support of that range as a stop loss, and we will target 1-to-1. Okay. Okay, so that's one. So we got another winner. All right, so let me see. That's 4 hours, so it is plenty. Okay, so let's say if I take this as a range build up, then I go and look for buy here. Sorry, just move this cross. Okay, so that's a range again. Okay, and if I took that as a breakout of that range, oh, and then I target 1-to-1. Sorry. Okay. Okay, so we got taken out for trade. Price hasn't shown any consolidation so far. By the way, we are using the same period, testing strategy number 1 and number 2 and also number 3. Yeah, but obviously the duration would slightly be different because it depends on how many opportunities arise for each strategy. Certain strategy will occur more often than another, and that will take our ending period slightly different between one strategy to another. But the starting point is the same, which was the 17th of June. I think it was a Monday. Okay, all right. Not really liking the consolidation range. Just not enough volume, enough range. Okay, just keep going. Okay, looks sorry, almost overdid it. Okay, this looks like a pretty nice consolidating range. Okay, all right. So if price breaks below the support, I will look for sell. If price breaks above that resistance, I will look to buy. Okay, so price, yep, closing below that support, and if I were to use that as a stop loss and target 121. In the trade. Okay, so that's +1 for the fifth trade. Okay, now we going to the sixth trade. And that's a pretty neat consolidating range, although not as high volume as I would like it to be. But anyway, it's a consolidation phase regardless. Okay, so I would look to buy if price breaks above that resistance, and I'll look to sell when price breaks below that support. Okay, you see how it's actually it did actually come out of that support, but actually closing back again inside that range, so that's not a break. Okay, no, not a break. Okay, so there's a break. Okay, because it's closing below, and I will use the resistance as my stop loss, and we'll target 121. Okay, so that's another win. So that's one. Okay, all right, so it's making another nice range here. Okay, so that's a nice consolidating range here. I would look to buy, there's a rule, look to buy above the support, and then use the resistance as the, oh sorry, use the support as the stop loss and target 1 to 1. Okay. Okay, so that's another win. Right. Okay, it's very small volume, but still, it's still consolidating. Okay, so that's price actually is breaking above that resistance. So I would look for buy here, and then look for our support as my stop loss, and then we'll look for 1 to 1. Okay, see how this goes. Feels like a fake out for me, but anyway. Oh, is it a fake out? Hmm. We're still in the trade. Just the way price actually reacts after it closes above makes it feel look like a fake out, but I could be wrong. There you go. Okay, so that's another win. So we need 2 more trades. Mm, okay, if I take this one as a, actually I'll take this one as a range sample. Okay, so price did break lower. So I would do this, get 1 to 1. In the trade, I must admit that that's probably not the best consolidating range ever, because it kind of sort of like skewed onto one side. Probably should pick a much more evenly spread consolidating range next time. But yeah, anyway, it's been taken. The trade. This is a long one. Okay, so that's out. Okay, so that's -1. All right. Okay. Right, so this is going to be the last trade, guys. Once we find another consolidation range. Okay, so I think this is quite nice range. Okay. Nope. Right. Okay, let's see. Okay, so price break above the resistance there, use this as a stop loss, and target the 1-to-1. Okay, so that's another win. Okay, all right, let's tally these results onto the spreadsheet. We just tested the strategy number 2, the consolidation breakouts. Let's tally these results up. Okay, so the first trade was a win. It was +1, and remember the rule for the second strategy, it was always going to be a static TP, static take profit. So the take profit is always going to be 1. So +1, second one was -1, the third trade was +1, the fourth trade was -1, +1, +1, +1, +1, -1, and then +1. Okay, so as we stand now without tweaking the strategy, the consolidation breakouts, it has 70% win rate, and also it has a positive expected value of 4. Right, and 1 and -1, again, as I mentioned before, depending on 1 is actually your risk value. So depending on how much you are risking per trade, if you are risking $10 per trade, that means in trade number 1, using consolidation breakout strategy, you would have won $10. And trade number 2, you would have lost $10, so minus $10. Which means that by the 10th trade, you would have gotten $40 because your EV expected value is 4 times your risk value. Okay, so that let's start testing strategy number 3 now. Let's go into the chart. Okay, guys, so we are going to test strategy number 3, which is the trend line breaks. Now the rules was if there is a trend line, an uptrend line, so price is creating a higher high and higher low, and once that trend line is broken, you would look into a sell position, and then you would put the stop loss around the area above that broken trend line, and then you would look for 1-to-1. And then if vice versa, if price is making lower low and lower highs, there's a downtrend, upon the break of that trend line, we would look into buy position, and then we put a stop loss below that trend line, and then we would target 1-to-1. Okay, so let's make a start. Okay, nothing just yet. Price still sort of going sideways. Okay. All right, and the trend line has to have a minimum of 2 touches. Yeah, that was actually one of the rules. Okay, so if that. All right, so first touch and the second touch, and that's the break off the trend line. So we look to buy there. Okay, and then we target 1-to-1. Oops. All right, that's the first trade. Okay, so that's the first trade. We had a loss. Oh, good. Now you have a new trend line, possibly. See. No, so we need 2 touches, guys. Nothing just yet. Okay, so this looks like a nice trend line. Okay. Okay, now this is called an accelerated trend line, where you have price making higher highs and higher lows, and then it actually took off just significantly further away from the original trend line. This actually happens quite often, so that's fun. We can actually work on this new trend line. Okay, and we will look into sell when price actually breaks into that new accelerated uptrend line. Okay, sorry, I think I overdid it. Okay, so because that candle there closed below the uptrend line, so we would look into sell. Okay, it's just above that trend line, and then we look for 1 to 1. What did I do there? Okay. Okay, so there was a loss, guys. There was -1. Price create another trend line here. Oh, okay, I want to. Okay, and then I'll look for sell because that trend line has been broken, so that candle actually closes below the uptrend line. Okay, 1. Okay, so we have a winner there. So that trade is 1. So we also have another downtrend line here. Okay, 2 touches, 1, 2. Okay, minimum 2 touches. Okay, so price still. Let me see if price close. Yeah, I know. Even though that, yeah, that's just not too convincing for me. I need a really clear close with the body above that trend line before we call it a break. And no, yeah, still respecting that trend line. Okay, so that's actually has already closed. Okay, I'll take that. Okay, and I'll target 1 to 1. Okay, so that's a -1. Nothing is just yet. No, a new trend has been created so far. Okay, so it looks like there's a new trend line here. Okay. Nope. Okay, so that's closed below that trend line. So I'll look into a sell and I'll target 1 to 1. Okay, so -1. And another trend line here, guys. So 1, 2 touches. No, hasn't closed below that trend line. No, coming back into that range. Okay, so that's a break. All right. Target 121. Okay, so that's a win. Okay, let's see if I can get maybe one more touch. Yeah, no. Okay, so that's actually a good touch. Right upon the break of that trend line, I would look into sell. Okay, 121. Okay, so that's another -1. Okay, so that's trade number 7. Okay. Okay, so that has closed. Oops. Below that trend line. Okay, so that means we can sell. Okay, so that's a win. 2 more trades to go, guys. Okay, so we have a down trend line here. Oh, not really, not yet. Okay, so that's 1 touch, 2 touches. All right, so I will look to buy here. Then we aim 121. Okay, so that's a -1. So last trade. And I will... Not yet, not yet. Not yet, still respecting the trend line. Yep, okay, so that's closed below that trend line, so we'll target one. Oh, we'll target 121. Okay, so that's a -1. All right, okay, so let's tally these results into the spreadsheet. Okay, now that we have the results for strategy number 3, which is the trend line breaks. Okay, so the first trade was a loss, so -1. Second trade was also a loss, -1. We had a winner, trade number 3, a loss, loss, a winner, a loss, a winner, a loss, and then a loss. Okay, guys, so that concludes our little exercise. Now we have sampled 10 trades of different strategies. The first one being the MA crossover. It gives us 20% win rate and then a negative EV of 1.68. And then the second strategy is the consolidation breakouts. It gives us a 70% win rate with a positive 4 EV. And then the last one, the third one, is the trend on breaks with a win rate of 30% and a negative EV of 4. Now, as we stand now, without tweaking anything or improving or changing any variables, it is pretty obvious that strategy number 2, which is the consolidation breakout, is the one with an edge comparing with the other two, obviously. And this is what I don't understand, guys. I've known people, amateur traders that likes to belittle other people's strategies. This is what I don't understand. A strategy is just tools, right, to make money in the market. There are so many variables that make up into a strategy. So what do I mean by this? Okay, now if you remember, if you go back to the slides before, each of the strategies has got, I would say maybe 3, 4, 5 different rules that I implemented. And these rules, as soon as you, and these are like variables, okay? So as soon as you change one, okay, just one simple little thing, okay, I can guarantee you that the result here, right, well here, right, leading up to the total win rate and the total EV at the end of the exercise will be different. Okay, just one. Okay, and if you change that by a little bit, okay, it's gonna impact on the win rate and the EV. All right, and if you change it significantly, like say for example, the consolidation breakout, one of the rule was you take profit 1-to-1. So you say, for example, you're risking 20 pips, then you would take profit at 20 pips in profit. Imagine if you change that take profit to 80 pips, for example, right? So it's a 1-to-4. Okay, I can guarantee you that you won't see a win rate of 70%. I can guarantee you right now, even without testing it, I can tell you it's not going to be 100% guaranteed. It's not going to be 70% win rate. Again, totally guaranteed. And if you start changing over these variables, the results for these strategies will either improve or be worse. So this is what I'm saying. Before you actually bury these two strategies, this trend on breaks and the MA crossover, saying that I've seen it in one of the YouTube videos, it doesn't work, consolidation breakouts is much more superior than MA crossovers and trend on breaks. I can tell you right now, I can tweak things in the consolidation breakout that would make it worse than MA crossover and trend on breaks, and I could tweak or adjust a couple of things in the MA crossover strategy and the trend on break strategy to make it to perform better than what they are showing right now. It is possible. Of course, you have to do a lot of trialing. You have to have some ideas or have some hypothesis to begin with, and then you test them, right? You test them, right? If it doesn't work, if it's actually coming out even worse, obviously you have to go back to the drawing board. But so this is the beauty about trading. A strategy is a strategy. It's not a be all and end all. Why? Because and I'm not even going into psychology at the moment. Yeah, I'm just talking about strategy. It's actually formed by different variables. Some strategy actually formed by a few variables. Some strategy are formed by many variables. Okay. Now, you as a trader, your job is to design, build, and test a strategy that is actually suitable for your personality, your risk appetite, your expectation, what you can get out of the market, your trading frequency. Some traders do not like to be in an action all the time. They prefer to spend a lot of time analyzing the market. And once they do the analysis, they would place one position, and that position will either get picked up or not picked up. And if it does get picked up, they will be in that position for days and weeks. Okay, and we call them swing trading or swing traders. Some people like to be in the action all the time, like high frequency trading. They could place anywhere between 20, 30, 40, 50 trades a day. Of course, there's no right and wrong answer. Only you need to explore, learn different strategies, learn different style of trading, and then only then you can ask yourself, okay, so what's actually comes most natural to me? Because there's no point forcing it in. It has to come naturally to you. All right, then you will then your trading journey will be much easier. Now, if you ask me, okay, so this is a sample of 10 trades. Now, does it mean that's actually enough to say that if we don't change anything, this consolidation breakout will remain 70% win rate and will give you a positive EV of 4 if we take more than 10 sample trades? No, it is possible for these figures to change slightly or significantly. We don't know. However, I always say, so if you ask me how many sample trades is actually enough, the best thing is you test it through time. Okay, if you can and if you have the time, I would say you test a strategy for 12 months period. Okay, why 12 months? Because within that 12 months period, the system gets exposed to different seasonality, right? You have the bank holidays period before the day before bank holidays, the days after the bank holidays, when the weeks are shorter by 1 day because of the public holidays, pre-Christmas, that holiday period, or post-Christmas after January, when the market's already open, but most of the traders or people are still on holiday. A lot of big news release throughout the year. The quarterly report, half-yearly report, annual report, all these sort of things, the system get exposed to just different seasonalities, different market environment. But even that, people always say 2020, 2021, 2022, 2023, 2024. Of course, the market changes post-COVID or pre-COVID or during COVID. But I would say 12 months is minimum if you could to test it through times. And if you could to get the samples as close as possible to the current market condition, I would suggest, for example, if we are now sitting in July, then you go 12 months back from July. Yeah, so let's say June, last month, June will be the 12 months, and then you just move backwards. Okay, so that's like, I think that would be, yeah, so July last year all the way to June last month. That will be a 12-month sample if you could. Otherwise, if you can't do that, I would suggest you take a sample of 100 trades, or 2 sets of 100 trades if you can. So the first 100 is a consecutive period. So for example, you want to start from January all the way to until you get that 100 trade sample, and then you stop. And then on the second sample of 100 trades, you say, for example, you pick that of May as your sample, and then as your second trade you would pick, say, 4th of April, and then the third trade you would pick like 22nd of February. So you just kind of randomize it and you just put it next to each other. The first 100, that was pretty much back to back, and it was actually in order. So the second 100 sample test, see whether your system is stable enough if things are being random. Because sometimes there are times in the year where market is just super conducive for most trading strategies. So let's just say you pick any strategy, because market is very conducive. It looks like you're just throwing a dart, and then the market will give you something. And then the following month, or a couple of months after that, suddenly everything just stopped working. Suddenly, okay, so this is why if you throw in that randomness in that second sample of 100 trades, it sort of tests that. Okay, so it doesn't have that pattern where whereas when you have a really conducive month, you don't actually have your equity curve significantly going higher and higher. It just gives you that more staggered result. And if that happens, we want to see what is your EV at the end of it. Okay, and again, this is a very simple, basic way of testing a strategy. Of course, if you want to go into it, it's going to be much more in depth, and I am planning to make a videos for that as well. This is just very basic because I'm only covering win rate and EV. There's much more to it than just win rate and EV for the strategies that you want to test. Okay, now to summarize our little exercise, although strategy number 2, the consolidation breakout, give us the best edge with a 70% win rate and a positive value of 4. As I mentioned before, this is not be all and end all. First of all, because the threat sample size is only 10. Okay, you need much more than 10. But the variables, the rules that actually make out these 3 different strategies are changeable. Okay, so even though the third strategy, the trend and break strategy, is performing the worst, not in terms of the win rate, but in terms of the EV, you can still change variables and rules in this strategy to try to make it better. Okay, there's no guarantee, nothing is guaranteed ever, but you can try to change the variables within it, and you can test it again, and then you can see if the changes actually improves the strategy or just making it worse. Same thing with this MA crossover. Before you say, "How look, MA crossover or the trend line breaks it just does not work," there are variables and rules inside this MA crossover that you can still change. Okay, simple things like instead of the MA 50 and the MA 200 they cross over, you can start changing it to if the non-MA cross above the 50 MA, then I will look to buy instead of the 50 crossing above the 200. You could change it up to 9 crossing the 50. And then vice versa, if the 9 MA cross below the 50 MA, then you look to sell. So whatever it may be, right? And you can still change it, and then you can test it and see if that gives you a better edge or worse. And so I've already put that disclaimer over there. Do not eliminate the possibility of using MA crossover and trend line break as a strategy, but just assume that nothing is changing. You don't plan to change anything else. And then say after a sample of 12 months or say 200 trades, you still see this kind of numbers at the end for these 3 different strategies, that the consolidation breakout still gives you 70% win rate and positive EV of 4. Then of course, after that massive exercise, you would come into conclusion that, all right, moving forward, I am going to eliminate these 2 strategies, and I'm going to actually focus on this one strategy, the consolidation breakout strategy, because it gives me an edge over the market. Because after a series of trades, that 100, 200, whatever trades that you took as a sample, it gives me a positive EV and also a very good win rate. Whereas the rest, it will be just like gambling. You knew that after a series of samples data, even though you could win 5 times of your risk here, but you are not winning it. You don't actually have enough edge over the market. You are not winning enough for that strategy to give you a positive EV at the end. Yeah, so sometimes just be careful. Even though so this 1 to 5 is similar to, in roulette table, I can't remember the exact odds, but sometimes obviously on certain bets you will get a multiplication of your risk of your bet. Yeah, even though you could actually win more than what you're betting, at the end of the day you still need an edge. You still need a good balance between win rate and the risk to reward. So in this case, with this only one time of your winning is 1 to 5 is still not enough to cover your other losses. Okay, so as we stand, again, only as we stand, if we don't plan to change anything, of course you don't want to be using MA crossover, this MA crossover as your strategy. You don't want to be putting your money into this strategy. You also definitely don't want to be putting money into this strategy as well, because it's going to give you even more loss, right? So if you do, it is as good as gambling. All right, that's not trading, that's gambling, because you knew that it's not going to give you any positive EV. Why you're actually throwing money there? All right, so because you're just hoping for the best. And remember when I said that gambling is luck fueled by hope, right? You just hope that your luck is better today than yesterday. So the difference between trader and gambler is the trader tests his strategy, and he approaches the market with logical analysis, and he uses sound risk management. And once he tests the strategy that he used on the market is going to be the strategy that provides him a positive EV. Whereas the gambler, the strategy is untested. He doesn't have a logical analysis why he enters into a trade, and he bets big or small based on his gut feel or his emotion. So if he's feeling confident or if he's feeling happy, he might bet bigger. And if he's a bit timid, then he will bet smaller. And he will have a negative EV on the strategy that he used because he hopes for the best. So the main takeaway points from this video is you need to learn a strategy or concept, and you need to test it. And once you test it, you need to find your edge. If you can't find a positive value out of your strategy, either you tweak it, you adjust it as necessary, and if it still comes negative, you need to go to the next strategy and then do the same thing again. Hopefully, this video gives you a better understanding on how to approach trading, that trading is a game of probability. And if you don't find your edge before you go to the live market, you're just simply gambling, because the difference between trading and gambling could be a very, very thin line. Thank you for watching, guys. If you find this video useful, hit the subscribe button and don't forget to like, comment, and share. Make sure you check out my other videos too.